assessing a new venture's financial strength and viability through important calculations, which is ROI, return on investment. Then you have internal rate of return, IRR. Then you have debt equity ratio and break-even analysis. And then there are other things that we'll talk about. This is something which may come across as a little eclectic, a little new, a little difficult, which I also had to go through. But then if you go through it a couple of times, you're going to become familiar with it, and you'd actually understand the virtue. Why do we do these calculations? And no single calculation can whether a particular business, let's say there are 3 or 4 types of businesses, and you have to decide which business to go ahead with, which idea to go ahead with. So there is no single calculation which will tell you that, this business is the best and the others are not so good. So there are various calculations that has to be done, and the sum total of all the calculation, when taken together, you will be able to figure out as to which business presents the best opportunity. Least risk, best opportunity for growth, and for other things. So first one is break-even analysis. Break-even point, break-even analysis. This is something which is used almost all the time whenever we are doing the pitching. So break-even analysis is, break-even point is a particular point. A break-even point is the volume of sales at which the business will neither make a profit or incur a loss. Now, you have spent certain amount of money on setting up of the factory. Let's say A. You have to spend amount B to run the factory, which is salary, wages, utilities, etc. And then you have let's say you have spent 1,000 rupees on setting up of the factory. Every month you have to spend 100 rupees to run the factory, and every month you are doing sales worth 150 rupees. Now, if you are making a product for 140 rupees and if you are selling it for 150 rupees, so per piece you are making a profit of 10 rupees. Now you are spending 100 rupees to run the factory every month. So if you sell one piece and you are able to generate a profit of 10 rupees, then you will have to sell 10 pieces to generate a profit of 100 rupees. And that 100 rupees will take care of the cost of running the factory. So when we are saying break-even point is the volume of sales. So how many pieces do you have to sell so that you are able to generate that much of profit, and that profit will be equal to the total expense of running the factory. So the number of pieces that you have to sell is called break-even point. It represents the volume of sales needed to cover total variables and fixed expenses. Now, variable expenses are your salaries and your raw material and other things. Fixed expenses are your overheads. So your variable cost and your overheads, that has to be covered by your profits. So we see that, so one question is that, how much is our total variable cost and fixed expense? So the accountant says 1 lakh rupees. And then you ask that, what is the cost of production? So the person says 100 rupees. And how much are we selling for? It's 110 rupees. So our cost per unit is 10 rupees. Okay. So if you have to earn 1 lakh rupees and we are making a profit of 10 rupees per piece, then we'll have to sell 10,000 pieces. Then we will be able to have a net profit of 1 lakh rupees. So the next question is, how much of sales do we have to achieve to break even? So that means you have to sell 10,000 pieces and you are selling it at 110 rupees. So you will have to do 10,000 into 110, which is like you'll have to do 11 lakh worth of sales to get a net profit of 1 lakh rupees. And that 1 lakh rupees is going to take care of the monthly expenses. And so that means you are on no profit, no loss. And that is what is called break even. So it is a technique which will help in determining the number of units which should be sold to achieve break even point. A break-even point or break-even analysis is very important. Everyone is going to ask you that. And then we have one section which is important and cannot be ignored. And all the mathematical wizards and all the investors, they always jump to this one: comparison of cost and benefit. Total खर्चा कितना आएगा और कितना हम कमाएंगे, cost and benefit. Determining present value of project cost and benefits. Now, you understand cost, yes, and you also understand benefits, the profits. Now, I want you to also understand the fact that, when you're doing business, there are various stages when you are spending money, and then there'll be various other stages where you will be getting money. When you're starting, then there are a lot of expenses, and at later stages, the expenses are less, but the earnings are higher. So the cost and the revenues, benefits, they are happening at different times. So when they are happening at different times, how do we, bring them together and see whether a particular business is going to be profitable or not? So what we do is that we do the time value of money. So meaning to say, let's say the time value of money is, let's say 10%. Meaning to say, today, if you have 100 rupees, after 1 year, the value of that 100 rupee is going to become 110 rupees. Meaning to say that today, if I give you 100 rupees, after 1 year, I expect that you give me 110 rupees, because the value of 100 rupees today is 110 rupees after 1 year. So what we do here is that you have to write down all the benefits and all the costs and when are they happening. So for example, after 1 year, you will be spending 1 lakh rupees. Then what is the value of that 1 lakh rupees today? You have to calculate that. It's a simple arithmetic, these things, just like we do simple interest. And let's say after 2 years, you will be earning 2 lakh rupees. So the 2 lakh rupees after 2 years, what is the value of the 2 lakh rupees today? आज से 2 साल बाद अगर 2 लाख अगर मुझे कोई देगा, तो उस 2 लाख का आज की डेट में क्या कीमत होगा? Obviously, it will be less. So, meaning to say that if you just do the reverse, that if I am giving you 110 rupees next year, it means you have given me the money. If you have given 100 rupees this year, and therefore I'll give you 110 rupees next year, because the time value of money is 10%. So if you want to do any kind of calculation, please look at all the expenses and at what times are they happening. And today, what is the value of those monies today? So you have to discount all those figures, discounted at the current rates, time value of money. So like I gave you the example of time value of money as 10%. So if the market value is, if the time value of money is 12%, let's say, in the market, meaning to say, आज का 100 रुपया मतलब 1 साल बाद आप मेरे को 112 रुपया दोगे, because the time value of money is 12%. So accordingly, whatever is the market rate, accordingly, you have to discount all the costs and all the benefits and calculate the current value as on today, and then you take the benefits and deduct the cost from that, and then see whether the business is profitable or not. So comparing cost and benefit, there are various methods. Comparing cost and benefits, benefit and cost streams form the basis of several measures of project viability, because everyone asks पैसा कितना लगेगा और पैसा कितना कमाओगे, and जितना लगेगा उससे ज्यादा कमाओगे कि नहीं, अगर ज्यादा कमाओगे, which means you are making money. So that is a simple philosophy, but then is treated at various levels using different techniques. So the 3 techniques that we are going to discuss, these are very famous ones, very simple ones, is net present value, benefit cost ratio, and internal rate of return. All of them are fairly simple to understand. Net present value resulting from subtracting the expected cost from the expected benefits. All your expected costs 1 year, 2 year, 3 year down the line, all your expected benefits 1 year, 2 year, 3 year, whatever number of years down the line, take the current value and then do the subtraction, the benefit minus cost. So NPV is net present value. आपका जो भी प्रॉफिट या लॉस या जो भी होगा इन फ्यूचर उसका करंट वैल्यू क्या है? दैट इज नेट प्रेजेंट वैल्यू. So projects with net present value greater than zero are worth undertaking. Meaning to say, you take the net present value of all the costs and benefits, and then you deduct the cost from the benefit. And if the value is greater than zero, it means this business can be done and you will be making some money out of it. Second one is the easiest one, which is benefit cost ratio. Simple as that. It is the ratio of the present value of the benefits to the present value of costs. So for a project to be acceptable, your BCR, the benefit cost ratio should be greater than 1. Meaning to say, you have taken the present value of benefits, you divide it by the present value of the costs. And if the ratio is more than 1, it means the benefits are more than cost. And therefore, we say that if the benefit cost ratio is greater than 1, then you can do the business. If the BCR is less than 1, it means you are going to lose money. The benefits are less and costs are more. An example, a BCR of 1.25 indicates that for every 100 rupees of cost, the project will return 125 rupees. If the BCR is 1.25, which means 1.25 is greater than 1. Now again, BCR is a relative measure of viability. Just from this BCR, you cannot decide that a particular business is the best. And therefore, we have different types of ratio analysis that we do to look at the business from all the different angles and then see whether all the angles are, speaking healthy about the business or not. And then we have internal rate of return. Now, the internal rate of return is the discount rate at which the present value of cost equals the present value of benefits. Net present value was सारे खर्चे लीजिए, कब कब होगा ये ले लीजिए, ऑल बेनिफिट्स व्हेन आर दे हैपनिंग ले लीजिए आप, सबका फिर करंट वैल्यू निकाल लिया, सबके करंट वैल्यू निकाल करके बेनिफिट माइनस कॉस्ट किया एंड देन सी कि हाँ जी पैसे बच रहे हैं कि नहीं बच रहे हैं, एंड देन यू नो हाँ एनपीवी इज ग्रेटर देन जीरो, वर्थ, सो द बिजनेस इज वर्थ डूइंग. नाउ इफ यू हैव थ्री टाइप्स ऑफ बिजनेसेस, the business which has the highest net present value will be deemed as the best option as per NPV. Second was your benefit cost ratio, which was fairly simple. Take the current value of the benefits, take the current value of the cost, and then divide the benefit by cost. If the ratio is greater than 1, then the business is worth doing. Any business which has the highest benefit cost ratio will be deemed as the best. Now, the internal rate of return is, again, what we are doing is, in this case, IRR is the discount rate at which the present value of cost equals the present value of benefits. Now, what we are saying is, again, the same thing. The data is, there are different stages where you have the cost. There are different stages where you have the benefits. Now, at what percentage should we discount the benefits and the cost so that the net present value is equal to 0? Meaning to say, the total benefit becomes equal to total cost. Or if the benefit is equal to cost, then the benefit cost ratio becomes equal to 1. So here we are not taking the standard prevalent market time value of money. We are not taking that as the standard. What we are doing is that we are looking at the cost and benefits, and then we are trying to figure out that at what percentage, if we discount them, then the cost and benefit become equal. So if IRR, internal rate of return, exceeds the opportunity cost of capital, then the project is considered to be economically sound and worth pursuing. Now, this is going to make more sense when we look at the example. So generally speaking, the higher an internal rate of return, the more desirable an investment is to undertake. That is, internal rate of return can be used to do the ranking for different investments, different projects on a relatively even basis. IRR is supposed to be the most important because it gives you the best results as compared to NPV and BCR. Now, for example, suppose an investor needs $100,000 for a project, and the project is estimated to generate $35,000 in the first year, second year, and third year each. 35,000 in first year, 35 in second, 35 in third. So the IRR is the rate at which those future cash flows can be discounted to equal $100,000. Now, what we are saying is that an investor is going to give you $100,000 now, today. Your projections say that, sir, every year, first year we will make 35,000, second year we will make 35,000, third year we will make 35,000. Now, what you have to do is that 35,000 in 1 year, you discount it by a rate, by a particular percentage. And let's say that percentage is X. So what we are doing is that we are discounting the 35,000 of the first year by X%, 35,000 of the second year by again X% for 2 years, and then 35,000 which was in the third year, you discounted by X% for 3 years. And the value that you get should be equal to 100,000. So at what rate should you discount the 35,000 first year, second year, third year, so that the current value becomes equal to 100,000? So it's a mathematical calculation, can be done in Excel sheet. And if you get a rate of, let's say, if you let's say the answer is 13%. It means that 35,000 in first, second, third year, if all of them are discounted by 13% and the current value is taken out, then that value comes out to 1 lakh rupees. So this 13% that you get, it means this business will grow at the rate of 13%. And when you calculate the IRR for different kinds of businesses, then whichever business gives the highest internal rate of return. So let's say there is one business which is giving an IRR of about 23%. Another is giving 17%. One is giving, let's say, 9%. One is giving 3%. Then it's fairly simple that you would go ahead with the business which is giving you 23% IRR. But again, you have to take it with a pinch of salt, because IRR, even if it is better than net present value or a benefit cost ratio, it is still limited. This is only giving you a certain level of indication. You have to do further calculations, further other ratio analysis to make your prediction more robust. But on the face of it, first three ratios that we do is, other than the break-even analysis, is your NPV, BCR, and internal rate of return. And this is the formula for internal rate of return. So what we do is that we set NPV is equal to 0. And what is the formula for NPV? NPV is equal to summation of T over 1 to T. Small t is a variable, and 1 means 1 year or time periods. And capital T is the total number of years that we are talking about. And then we have CT on the numerator, which is net cash inflow during the period. And C0 is the total initial investment cost. IRR is the internal rate of return, and small t is the number of time periods. So for example, we'll keep it simple. We just, let's say we'll take the time period as 2 years. So if you take 2 years, then the value of small t is equal to 1, and then one time it is 1 and the other time it is 2. Now C0 is the total initial investment cost. Now C0, C0 is total money that you have invested today. Today what you are investing at the start of the business is your C0. CT is the net cash inflow during the period T. The small t was, we have taken it as 2 years. So CT means the expected cash flow that you are projecting in 2 years. So let's say you have invested 1 lakh rupees. So C0 is equal to 1 lakh rupees. You are expecting that in 2 years we will be able to earn 3 lakh rupees. So C0 is 1 lakh and CT is 3 lakhs. And the value of small t is equal to 2 years. So you do the summation where t is equal to 1 to capital T. The value of capital T is equal to 2. So one time you take the value of t as 1, second time you take the value of t as 2, and then you do the summation. So first year and second year you do it, where the value of t changes from 1 to 2, and based on this and equated to 0, you will get the IRR, the internal rate of return. And that internal rate of return will be in terms of percentage, which is 18%, 17.5, 12%, whatever. So you do this calculation a couple of times, you would get a hang of what does it mean. And the value that you get is the rate at which the business is expected to grow. That's what IRR gives us. So those are the three things other than break-even analysis. And then, so that done, the rest of the things are fairly easy to understand. We'll just take them one by one. Cost and financing startup cost. Now, you have to be prepared when you are doing your budgeting and other things. You have to be prepared for such questions like if someone were to ask you that what is the amount of money that you require to start up. That is your startup cost. You haven't started operation, you're not running the factory, but what is the cost of setting up the factory? And some investor may say that I will give you the money to start up, but I'll not give you the money for operations. Meaning to say, I'll give you the money for setting up of the factory, but to run the factory, the salary, wages, raw material, etc., you have to arrange that money from someone else. So you should be prepared with that figure. What is your startup cost? And assumptions, it is important to always explain your numbers. Assumptions would be in terms of how much sales would you be able to achieve, what is the per unit cost that you'll be able to achieve, how much daily production you'll be able to achieve. So whatever numbers you put over there, it has to be based on data. And the data is going to come from primary as well as secondary data. So if in general people are able to, let's say half a dozen t-shirt makers are able to make 1,000 t-shirts per day using 100 machines, then you can also take that average. If you take a much higher average, anyone is going to ask you, how come you have taken a projection of 1,000 t-shirts per day when no one else is able to do it in the market as of now? So whatever you're assuming, the reasons have to be given over here. And then things to remember, honest projection, you will always have to justify your numbers. Don't ever overinflate your numbers to impress the reader. An experienced business plan analyst can sense dishonest figures and will always want to know where you got your numbers from. Keep your figures honest. If anyone gets to know that you are being dishonest, trust me, one investor can tell all the other investors that, I came across this person, very dishonest. Just in case you also come across this person, don't get tempted. Or don't work with this person. So not at all advisable to use dishonesty in trade. Be conservative, never be very flamboyant, very optimistic. So always go with a conservative approach. Don't be tempted to paint too much of a rosy picture for your business. Tell it like it is and you'll gain more credibility from the reader. So when you're talking about the competition, please tell that the competitors are very, very strong and it's going to be goddamn difficult for you to survive, and life is not going to be easy for you. You can't say that we have a great product, a great team, and we are going to be absolutely amazing in the markets. No, you're not supposed to say that. You want to talk about the risks. That the risks are there, and we also have various plan B in place just in case things go wrong. So be conservative. And then use standardized financial sheets. Now, this one is there's not much to be added here. The sheets, the financial sheets that I showed to you is something that is used in India as well as abroad. Everywhere, the same format is used. So don't get fancy when you're preparing a financial plan. Don't use shades or pretty colors. Use standardized forms and avoid clutter. Your financial statement must be clear and easy to read rather than, putting in glamour and bling and things like that. And choose the appropriate accounting method. So decide which method of accounting you want to use, cash or accrual. Cash accounting is exactly what it means, and you record the transaction when you get the cash. So cash or accrual is fairly simply said. In fact, for example, if you made a sale of $500 in January and you get paid in March, then you would record the transaction for March. That is cash system. Accrual accounting is when you record income and expenses when they were originally transacted. So for example, if you made a sale of $500 in January, you would record it in January only, regardless of when you receive the cash. So if you are following cash, follow cash throughout. If you are following accrual, then follow accrual throughout. don't shift from one to another. And this is something which is never done by anyone. So yeah, and be consistent. Use one method for all of your accounts. Otherwise, you might end up comparing apples to oranges. So these are some of the things to remember, and the rest of it is entirely up to your own capability and credibility and the hard work that you put in. And of course, the last slide is be consistent, which is the most important one. So that brings us to the end of this session, and very important session. And I wish you good luck with your startup. Now that the finances are clear, at any given point of time you want to ask, or if you, in fact, this is something that if you do a little bit of reading, your understanding is going to get more, solidified, more internalized, and you would be far more comfortable discussing things with your chartered accountant and with any of the investors.